Welcome back. Time now for the Word on Wall Street. Top investors watching your money. Joining me now is Verdence Capital Advisor CEO Leo Kelly. Also with us is Lloyd this morning. And it's good to see you, Leo. Thanks very much for joining the conversation. I want to kick things off with you, thanks. Luke, with a market that is higher this morning once again, extending yesterday's Friday's big rally. The Dow right now up 21, the S&P up 21, and the Nasdaq up 129. On top of a huge move on Friday with the Dow up nearly 500 points Friday, the Nasdaq up 200, sparking some hopes of a stability or rebound from this recent pullback. The White House reportedly preparing backup plans in case the Supreme Court rules against President Trump's emergency powers on tariffs. We just spoke with Commerce Secretary Howard Lutnick, telling me in the last hour he fully expects the president to be victorious in this case. The president wrote on Truth Social last night this tariff power will bring America national security and wealth, the likes of which has never been seen before. Those opposing us are serving hostile foreign interests that are not aligned with the success, safety, and prosperity of the USA. Luke, while the president is defending his tariffs, at the same time, we are hearing expectations that he's going to be cutting certain tariffs on certain foods as the issue of affordability takes center stage going into the midterm elections. Your reaction on how this plays out?
In Brazil was the latest, and specifically a stock we own, Dow, which is Dow Chemical. Those should benefit from tariffs coming down, and Brazil specifically having moderate exposure. But every morning in our newsletter, we take a look at three things: inflation, growth, and liquidity. And liquidity, for the first time in a long time, was actually looking pretty weak because of the government shutdown. That's come back in the system. But let's talk about the government shutdown and the impact. 2018 to 2019, the government shutdown impact was only negative 0.3% of GDP. This time around, over 40 days, and about $300 billion worth of GDP, it's expected that 1% of GDP, negative 1% contraction is expected this time because of how reliant we are on the government, even compared back to 2018 and 2019. So that GDP contraction is going to actually took a little bit of liquidity out of the system. If you look back throughout history, an interesting statistic is a negative 1% contraction in GDP correlates to 5 to 8% downturn in the market. Where was the Nasdaq just a few days ago? It was a negative 8% correction. So we are actually buyers of the dip going into this because liquidity coming back in the system. We think the markets are ahead of this contraction that's coming in Q4 a little bit, not contraction. It's still a growth, but negative 1% decline of what was expected. That Hassett was mentioning, and Lutnick also, I believe, referred to just earlier. So we're buyers of this dip. We just bought OWL last week. We've actually added to some positions last week as well. So I think this is a good area to get new money to work if you don't have money on the side, or if you do have money on the sidelines. Yeah, I mean, a bit of a debate, Leo, about AI stocks. Of course, we are seeing such a huge run-up that investors have become concerned over the potential bubble of AI-related companies and all the money that has been allocated for, data centers, build-outs, despite the numbers from NVIDIA last week. You say the recent AI sell-off was bound to happen. What do you see happening now?
Well, yes, Maria, it's bound to happen. You're starting to see some similarities, and I know everybody likes to dismiss the similarities to the 2000 through 2002 bear market, but they're remarkably similar. The infrastructure build has been extraordinary. This is generational, as we know, but we're starting to see very similar patterns. The market is starting to get more volatile around these stocks. There's starting to become some questions. Just as with the internet build out, where Cisco was the NVIDIA of that build out, we had a couple companies who were very strong, yet they still fell once the market turned over. And I'm also starting to see some other interesting things, like the financial doom loop, where the seller finances the buyer to buy their product. Valuations are starting to get extremely high. We're starting to see these budgets start to be questioned about how much money is going in to AI. And very much like the internet, the whole AI trend will be successful. And all of this excess capital coming into the market is going to help AI become far more successful faster than it could have otherwise. So not all bubbles are bad. Now, that said, you have to be disciplined in your asset allocation and your approach. Where people got hurt in 2000 was where they over-allocated and they let their positions run too far and they got overly optimistic. I would point out one other thing, Maria, in 2000, the market had a couple moves like this, 8, 10%, 99. We had a big move down in March, and it rallied all the way back. It went down, it was in a full bear market, rallied all the way back in July before we finally corrected the market. I would say there's two important factors to think about here. One is the volatility is going to increase over the next couple quarters with AI and AI stocks and technology. And two, this will be successful, and keep your eye on what's coming next. This is the infrastructure. What's coming next is application.
Yeah. Well, I mean, when you say what's coming next, I mean, are there companies that you can identify that have perhaps not, participated in this rally? Because I remember in .com, we had so many boats that were lifted, but at the end of the day, when there was the real shakeout, there were a handful of companies that kept on going and created massive, massive wealth and gains, like Google, like Amazon, like Apple, so many. Right. But then there were a lot on the cutting room floor. So how do you identify those winners and identify those who actually won't make it?
Well, Maria, that is the point, right? So when you have these generational moments, like the internet, like mobile, and like AI, like railroads, you name it, the infrastructure build always gets this massive bubble movement, and the big infrastructure stocks, they bring in so much capital, it helps them to build the infrastructure. The application companies like Amazon, like Uber, like Google, they weren't actually around when it first crashed. They came out of the crash. They're the application. I would tell you, Maria, we're investing quite a bit of money in the private equity markets because I think the companies that are going to have the greatest applications are like Google, are like Uber. They're not even around yet. The applications are coming, and I think you need to be in the venture space right now to take advantage of the applications that will come next. I know it's complex, but that's where you have to be, and you have to take the risk to be in venture.
Meanwhile, markets are closed this Thursday, of course, for the Thanksgiving holiday. They'll close early on Friday at 1 p.m. But we've got more data coming out this week, Luke. We've got shutdown delayed data rolling out, including the September retail sales. The PPI is coming out tomorrow. Initial jobless claims, durable goods, and the next read of third quarter GDP on Wednesday. You've even got major earnings like Deere, Dell, Zoom, and Alibaba. Do you have an assessment of how this economy plays out in the fourth quarter and into 26?
Yeah, so I mentioned the government shutdown. So fourth quarter is going to become a little bit lower than maybe the initial expectations earlier this year. But look, I want to hit on Leo's point, which was a great point about the next application of AI, which goes into kind of this economic data and as we head into 2026. And that is that this time is a little bit different. I know in finance and investments, you don't always want to say this time is different. But, with AI and this AI, what if you want to call it a bubble, if you want to call it whatever, this AI application and technology makes every company a technology company. Small business, every small business in America, every corporation out there can use AI. I use AI every single day in my business. So my point is with that is the money has flowed to the top Mag 7. We're not investors into the Mag 7. We're investors in the other 493 right now, and we're adding to those positions because as that money flows throughout the economy, you're going to get a mean reversion to the valuation. And some of those maybe big tech stocks actually don't do too well and the others do. So the economic data, I think, is still going to remain well because liquidity in the system remaining strong, growth remaining strong, and inflation coming down. As long as those three metrics look good, I think the economy is going to continue to rock.
All right, and don't forget, we got the big, beautiful bill and its impact next year, so that should certainly give us a lift as well. Luke, Leo, great to talk with you both. Leo, thanks very much for joining us. Luke, you'll be with us all morning, and we're grateful. Happy Thanksgiving, gentlemen.